things about being an investor these days is that there's just a wealth of information that you can access about everything about investing, ranging from specific individual investment products to specific investment strategies. And you can get to hear the good and the bad about it, and I think that's great. The one thing you got to be careful though with such large quantities of information out there is a good chunk of it can be noise. And it's really important to be able to develop the skill for filtering out the good noise from the bad noise. And one of the things I do when I work with clients is to kind of teach them how to be able to filter out that noise and more specifically understand who the players are who are putting that information out for consumption. Because that can have a positive or negative impact on how you formulate your investment decisions. So I thought I'd like to share with you an example of one particular case of one person who's got a lot of street credibility out there in terms of a specific type of investment strategy. Out there in the investing world involves what is an appropriate strategy for buying and selling stocks. And there's essentially two different camps out there. One is a passive, that believes in a passive investment strategy, and there's one camp that believes in an active investment strategy. Now, for those who aren't very aware of either, an active investment strategy is just simply the ongoing buying and selling of stocks, either by individuals or by a mutual fund or a professional money manager. And what they do is they incorporate various analytical techniques like analyzing the company's financial statements, analyzing the business model, their competition, looking at global economic factors, and taking all these variables and formulating them to make an investment decision. Now, the goal being is to try to buy stocks that are going to outperform the overall market. Passive investment strategy, on the other hand, is taking a much more hands-off approach to making investment decisions, and it basically involves a very limited amount of buying and selling of individual stocks or mutual funds or exchange-traded funds. Very little analytical work is done. You're just simply buying a stock or buying an index or an exchange-traded fund to get exposure to a broad base of stocks, and with the intention of essentially earning what the market earns. It's not about trying to outperform the market or trying to get a superior type of performance. It's just all about being exposed to the market. The great thing about passive investment strategy is that it's very hands-off, and it allows you to get exposure to the market at a very cheap cost and with very minimal effort. So if you don't have the time or the wherewithal to understand the intricacies of how stocks perform and how they work, a passive investment strategy is probably a better way for you to go. In the various investment circles, there's a great debate about which style or which strategy works best. And there's a lot of research out there now that's shown that a passive investment strategy will outperform an active investment strategy. Essentially, what it comes down to is people that are engaged in active investment type strategies tend to underperform the market. They don't even earn the market rate of return. I think the last research report I've seen many research reports saying that almost 75 to 80% of mutual fund investors or portfolio managers that are out there cannot earn a market rate of return. So what it says is that you're essentially better off just taking a very passive approach, buying a set of of index funds or ETFs, or buying and holding stocks for long durations of time, and you have a better chance of outperforming some of the professional money managers. Now, there's various people out there who are just essentially will pound the table on the virtues of one investment style over another, and the one I want to share with you today is one person, Mr. Ferri, who's basically a champion, self-proclaimed champion of passive investing, and has penned various books, including The Power of Passive Investing, More Wealth with Less Work. Now, if you go to his website, you can actually read a little bit about his book. In his bio about it, he claims that, quote, investing to earn above market returns with a portfolio of actively managed funds is both a waste of time and money. A well-designed passive investment approach that utilizes index funds and ETFs has the highest probability of meeting your financial goals and is the most prudent choice for your money. The power of passive investing will show you why this is true, as well as how this approach can work for you. Now, Mr. Ferri has also posted various blogs on his website, and talking again about the virtues of passive investing. So, and I've listed a few here, like busting the stock pickers market myth, 3-to-1 odds favor index investors, too much indexing is not a bad thing, coin flipping outdoes active fund managers, and another reason to buy index funds. Now this is all well and good, but recently Mr. Ferri penned a blog article entitled Confessions of an Index Investor, where essentially he admits, and I quote, "The problem with being the indexer, quote unquote, is that I don't invest in all index funds. Truth be told, my portfolio is a combination of funds that follow indexes, quantitative funds that don't follow indexes, and actively managed funds. I don't even consider following an index as being paramount in portfolio management, as long as you're capturing the risk premiums you're seeking in a low cost and efficient manner." He goes on to say, "How to determine if a unique risk exists in an investment where there is where fundamental analysis comes in. You'll have to dissect what makes the investment tick. This can take a lot of time and effort. If you're not inclined to crunch numbers until your eyes turn red, I suggest Andy Lehman's excellent 570-page reference guide on the subject titled Expected Returns, an investor's guide to harvesting market rewards." To me, this Mr. Ferri's comments really flies in the face of everything that he's kind of branded himself to be in his books and his blogs. And I have to give him credit first that he's actually done a commendable job of raising the virtues, and he's articulated the virtues of passive investing, because clearly there are benefits, and the performance out there reflects that. Now the question is, so, he's selling books, so obviously he's got a following, but now he's saying, basically you can't do it. You have to adopt really complicated analytical processes. You have to adopt risk analysis. You have to read 500-page books. That's not what passive investing is all about. So, what's an average investor to make of that? To me, there's no single product or strategy out there that is like the holy grail of investing, that thou shalt do this strategy and you will be successful. I think with respect to passive and active investment strategies, I think there's a place for both of it in one's financial plan. I think what's important though is undertaking the due diligence to evaluate and understand what's behind those investments. And in that process, it's also important to do your due diligence to understand who the players are and where that messages and information is coming from. Because as you can see in the example of Mr. Ferri, he's out there, he's been out there pounding the table on a specific strategy and getting people to buy books on it, and at the same time now is coming out saying that it really doesn't work, that you really can't use that kind of strategy. And to me, I find that to be very disingenuous. And it's hard enough right now for investors to figure out what to do. And I work with a lot of people who are just confused and are just looking for something that can give them some structure. And when I see stuff like this, it just makes things harder and makes me more determined to make sure people develop that skill set for filtering out information. As an investment coach, I probably spend just as much time teaching people about the psychology of investing and understanding the players in the investing, in the investment game. As I spend as much time doing that as I do teaching people how to, interpret an income statement or a balance sheet or, interpret financial ratios. It's, as an example, I hope shows is that you need to be really always, as an investor, kind of questioning a lot of the methodologies and concepts that are always being put out there by various constituencies, and especially the ones that are, the proclaimed experts or the, stock market gurus out there, because a lot of times, more times than not, they're kind of working under their own specific goal or an objective that may not be in alignment with what your goals are as an investor. So it's just important to be mindful of that.